Welcome back. You're watching Bulls Charge Ahead. This is, of course, the Fund Master Special. My next guest today is Anand Shah of BNP Paribas Mutual Fund, who sees structural issues in IT sector, but says there's a lot of bottom-up stock picking opportunities in pharma and also in Indian consumption, including airlines. Here's an excerpt.
It's been since September 13 that we have this a sea change in terms of how the monetary policy is conducted. And we are seeing the positive real rate of interest with a lag now having an impact where there is a tendency for investors and households to have more savings in financial rather than the physical. So there is clear trend shift from having savings into real estate and gold towards financial assets, which includes bank deposits, mutual funds and insurance. And that actually the biggest beneficiary will be the financial sector. So that's one part of the story, that on the liability front we are seeing a very benign environment for the financials. At the same end, if you see the composition of the stocks within our financial exposures, you will see there will be a tendency or there is a large inclination toward having banks and financial institutions which lend to the households. So on the asset side, actually there is very clearly one segment of the market which is significantly under leveraged and has a room to grow significantly is the retail assets. So that's a combination where you have a benign liability environment which is going to sustain for a while, especially after demonetization is further improved. And on the asset side, this is the segment where the growth is there and the competition is still not spoiling the market as such.
The other space which has made you a lot of money, of course, is consumption. The likes of ITC and even autos like Maruti. Do you get a sense that the rally that we are seeing in these spaces has more legs, and would you be topping up on some of these investments?
Yes, so frankly this is a space which has not disappointed us for last 2 decades, and the Indian household has been upgrading in its terms of consumption. Yes, the segments which have really done very well have changed every 5 years. That continues to look good. On top of it, what we are seeing is GST having a lasting impact on many of these, not all of them, but many of these segments of the companies where there is a shift from unorganized to organized. And to that extent, I think there is enough and more stock picking opportunity within the consumption space, especially on the consumer discretionary space, which can last for a little longer.
Well, Anand, just talking about, the so-called dogs of the market, IT and pharma, and the sort of bottom fishing that's going on. A lot of people in search of value. I know you've stayed away from these sectors largely. Is there any rethink on that strategy?
So, frankly, while a lot of noise around, the new presidency in US and the rupee appreciation hurting this sector, but we've been actually studying this sector for quite a long period, and we have people within our team are quite experts on that. We see quite a lot of structural issues with IT sector now for more than 3 years, where the traditional business is actually under huge pricing pressure. There is a rapid commoditization of the traditional IT business, which is causing a structural slowdown in that part of the business. And that's something which is still worrying us. Yes, the emerging segment within that will grow faster, but that even today is quite small for a lot of Indian IT companies. So we've been watching that space. The balance sheet is good, return on equities are very high, cash flows are great, and to that extent today you have a valuation comfort. We would look for the turn in terms of growth. So because at some point of time, the pace at which the traditional business is softening in terms of growth will be compensated by the growth of a new business is when we would turn structurally positive on this sector. Till then we've been sort of cautious, and this H1B related costs and rupee appreciation will be a further headwind into this challenging environment in which IT sector is working. As far as pharma is concerned, it's again a sector which has already been challenged in terms of growth and particularly pricing pressure in US. But on top of it, you had regulatory approval delays because of the US FDA inspections. And to that extent, this is a sector which is in the mend. There are a lot of bottom-up stock picking opportunities in the sector which we are quite convinced of, but overall on the sector as a whole, there's still 6 months to 12 months of correction in terms of pricing pressure challenges in US is concerned has to go through before we can turn constructive on this sector.
Okay. You have investments in Indigo as well, Anand. Just wanted your thoughts on whether, you're getting sleepless nights because of their interest in Air India, or you think that will be a good fit for them?
So this is one of the many sectors we have invested in, which is linked to consumer discretionary. So we have exposure to an entertainment sector or airline sector, which is actually a play on the Indian middle class upgrading in terms of the consumption, be it multiplexes or in terms of transfer of usage of from rail transport to the air transport. So first and foremost, the entire exposure to the airline sector is due to a rapid growth of passenger. And to that extent, this is a play on the Indian consumption. That's what you asked me before also, that the consumption is something which is played beautifully over for us in many companies in the past, that continues to play now in the discretionary space. As far as the implications, frankly, I'll refrain from giving any views on the stock-specific ideas.
Okay, that's domestic funds. We have seen a lot of FII selling, but one fund manager who has stayed invested in India and has in fact added more of late is Jonathan Schiesel of Ashburton. And earlier in the day, we spoke to him and asked him whether he has added to his India weightage.
The view between both China and India, how we work it in that particular fund, is more on the technicals of the China market. India, we're sort of slightly more long-term in how we play that. So if we go underweight India or overweight India, to a large extent depends on our view on China and various technical factors that go into forming that view. So currently, actually, we're marginally overweight China within that particular product. Have we been putting more money to India, back into work in India more recently? I think obviously the market did correct a little bit, and obviously we've moved straight back up again. So, we're certainly telling people, and we're certainly trying to, buy the dips as such, and we still think the India story looks attractive.
What's the approach to the Indian market right now? Are you thinking of changing around any sort of sectoral holdings?
Yeah, we like the mix, but IT is one where we've been putting money to work in over the last month and a half, and it quite frankly hasn't worked yet. Clearly IT is still under some pressure. Our view would have been that some of the bad news is in the price. We like the cash returns that these stocks are now generating, and we think a lot of the negativity, certainly around the US, is as we said, more in the price there. So, we had put money to work there, but it hasn't exactly worked very well at the moment. Otherwise, we've certainly been upping our materials weightings a little bit over the last few months. Specifically just trying to get stocks and names which are a little bit more economically sensitive to a recovery in India, which we do believe will be sort of ahead of us. Obviously GST might disrupt that by 1 or 2 quarters, but we're quite confident in a recovery over the period ahead. So, yeah, since we last spoke, we probably upped the materials area, upped the IT area a small amount as well. And we've taken a little bit out of some of the consumer names. Some of those consumer names, or the structural growth names that we know so well in India, are trading, obviously in some cases, eye-watering valuations. It's not that we think they're going to derate, because actually there are some phenomenal longer-term growth stories in those stocks. It's just there is so much optimism and in current valuations in some of those consumer-facing stocks.
It's interesting. You're saying you've actually upped the IT weight since we last spoke. At the same time, you're also acknowledging that that's a call that hasn't really worked. What's the thought behind IT? Are you going to keep patience with these companies? What would you want an Infosys to say in the first quarter so that you keep your faith on the sector?
Yeah, look, we've been tested. That's for sure. I think, a lot of investors, when they ask us, where do you find value in India? And certainly in pockets of IT, you could argue you've got value. We just haven't had the catalyst to realize that value just yet. So clearly, the issues for us are, constant focus on that revenue line. Commentary is clearly very important, deal wins, et cetera, et cetera. Certainly the market is sort of downplaying again the upcoming numbers. I think the market's beginning to price in a bit of earnings disappointment in the very short term. And if the stocks come off a bit more, we'll probably be looking to add to them. you know, for us, on an overall portfolio basis, we like to keep a balance. Sectors sometimes don't work, and they cannot work for a very long time. But, you know, at the end of the day, we have a diversified portfolio. We've got some sectors that have been doing incredibly well. But, you know, the market shifts and rotates all the time. So it's quite useful having weights in some of the under-owned, under-loved sectors. I mean, in addition, we have nothing in the staples area. I mean, clearly that's a very expensive area. But obviously, if volatility comes back, it'll be interesting to see how staple stocks react. I think actually you might see IT behaving a little bit better in a volatile period, just for the simple fact it's an under-owned sector.
Oh, yes, and take that point, Jonathan. Of course, you know, we are looking at just last 1 year performance. Some of these stocks, of course, you have been holding Sun Pharma, for example, maybe, you know, before it became that, you know, multi-bagger. So maybe you can take that near-term pain. But pharma has also started to move off late. And I ask you because you have large holdings in Sun Pharma. Do you believe that the Indian pharma story is intact? Because that's the big call, right? I mean, stocks can correct, but the question here is the story intact?
Look, I mean, globally, if you think about generics, yes, clearly there's a lot of headwinds now facing that sector. And then in addition, you know, I think that's been felt by some. The FDA of the US seems to be very focused on the Indian companies. I think that's not quite right. I think it's globally that they're clearly very focused on all generic companies globally. We keep a beady eye on what's going on to the generic names in the US, and it's been a disaster. It's been a bloodbath for the last year and a half. And Sun and the rest of the Indian players have equally been derated over that time frame. I think value is beginning to appear in some of these areas. We haven't started to redeploy cash into pharma names just yet. I think those headwinds are still there, and yeah, we're holding the names, and as you rightly say, we've held them for a very long time, and that they were very profitable names for us for a very long time. But obviously, more recently, it gives us a little bit of latitude to sort of cope with them.
Jonathan, Indian financials, what's your reading, and how do you rate this whole process of sorting out the bad loan problem? 12 accounts going to the bankruptcy code now. Are you buying more of the PSUs? Do you think they'll be able to sort the mess?
We don't own any India PSU banks. We haven't done for many years. I think there's structural issues that keep us away from those particular counters. Yes, they were looking cheap, but there's a reason for that. Financials we do like. Obviously, you know, we've been positioned in some of the mortgage players for some time, and I think actually I know that there's been a lot of talk over the last few months about obviously the whole push for economy housing and then, you know, the products around that. So I think that's a story that'll be here for a long time. So we still very much like financials. We have been redeploying cash back into some of those names, but we're still very fond of the financials here, particularly as you rightly say, some of the resolution that seems to be getting closer on the NPLs.
Well, with that, it's a wrap on this edition of Bulls Charge Ahead. Thanks a lot for watching CNBC TV 18. Have a good weekend.